Inflation, of course, is a major topic right now. Despite the Fed's assurances that the current spike in inflation is only temporary, we've heard Warren Buffett warn that inflation is rampant across Berkshire Hathaway's businesses. For investors, Michael Burry's latest short on bonds is something to keep an eye out for. But how does it impact us, and what is the best strategy to deal with a period of rising inflation? If you're worried about this issue, then don't worry, because InvestTops is here to educate you. In this video, we'll take a look at some of Warren Buffett's most recent yearly letters to see what advice he can give to us when it comes to investing during periods of inflation. But before that, please click the like button to help our channel bring more people into our little bubble. While you're at it, click the subscribe bell icon to this channel and stay on the loop with the latest videos on personal finance and investments. Now, let's proceed. As investors, we tend to look for opportunities where we can put our money into an investment and get it back at a later date. To better understand inflation and investing, it's helpful to think of it this way. We're sacrificing a portion of our purchasing power now in order to gain more purchasing power in the future. Or we're giving up the purchasing power to buy 100 burgers now in order to buy 150 burgers later. Inflation can eat away at any gains you earn on an investment over the course of several years. So, even if you see a 20% gain on paper, your true return could be as low as nothing. Before you could buy 100 burgers, make a 20% profit, and then resell them. But due to inflation, only 100 burgers are currently available. Your purchasing power has decreased instead of increasing. In 1979, Warren Buffett was onto something when he said this. He claimed that a few years ago, a company whose net worth per share compounded at a 20% annual rate would have guaranteed its shareholders a very successful actual investment return. Inflation and individual tax rates will play a major role in determining whether our internal operating performance leads to profitable investment returns. Previously, this outcome seemed more inevitable. The original 3% savings bonds, the 5% passbook savings account, or the 8% US government note have all been changed by inflation into financial products that deplete rather than increase purchasing power over the course of their investment lives. As an example, even in inflationary conditions that are not significantly worse than the current situation, a company that earns a 20% return on capital can yield a negative real return for its owners. This happened in 1979, at a time when consumer prices had risen by 11%. Even an 8% guaranteed government bond isn't getting us what we used to get in terms of purchasing power. In the past, however, investors were still losing out on purchasing power because of this. According to Buffett, an investor's misery index can be calculated by adding the inflation rate and the owner's share of the capital outlay to the company's annual profits, such as ordinary income tax on dividends and capital gains tax on retained earnings. Investors' real capital shrinks even though they consume nothing. Rate becomes higher than the company's rate of return on equity. As a result, investing during a period of high inflation is difficult, since Even if the company does well, your real return on investment could be negative due to the annual percentage loss of purchasing power and the taxes you must pay on dividend income and capital gains. Buffett drew this comparison in 1980, which we really like, where investors and businesses alike are experiencing a roller coaster ride as the pace of inflation accelerates to the point where their upward progress is zero, according to him. Inflation, of course, reduces their purchasing power. To stay afloat in today's economy, firms must purchase a large amount of goods and services. Those who depend on this merchandise will find themselves in a bind if the price increases. To make a profit, they can either pay a higher price and lose money, or they can try to raise prices in the hopes that their sales volume will not decrease. Inflation can also put upward pressure on interest rates, which can make it harder for companies to access loans or make pre-existing loans more expensive to pay off. And this makes it much harder for investors. In these instances, you really need to pick great stocks that are going to compound your money over time. Is there anything else we can do to fix this problem? As a result of Warren Buffett's research, we now know what kinds of firms do well even when inflation is high. To be considered favored, a company must be able to raise prices easily, even when demand is flat and capacity has not yet been fully utilized, without fear of significant market share or unit volume loss. First and foremost, the power to raise prices with no repercussions seems reasonable, doesn't it? Increased costs are hurting the company's profitability, so why not pass those costs on to the customer? You'd think, wow, that's out of this world. No business could do that. And you know that consumers would simply go somewhere else to buy the cheaper product, but not if the company had a moat. For example, imagine that you're running a modest film production company. All 50 of your employees have been trained in Photoshop, Premiere Pro, and After Effects. And it costs you a lot of time and money. There's a sudden increase in Adobe's monthly fee, and then you decide to transfer to a less expensive service. You might be able to locate something for $20 less a month. That's excellent, but it lacks some of the functionality that the team is accustomed to. It will also cost you $200 per employee for training. Not to mention the downtime your firm will suffer as you implement the new software and transition everyone over to it. Then you think about your clientele. Already your customers are causing you anxiety. They're in a rush to accomplish their projects, and it's simply not worth it to switch now. So, now what? You'll simply have to fork over a bit of extra cash. Staying with Adobe means paying a premium. Here's another one from the real world. It's totally reasonable for Apple to extract more and more money out of their customers each year because they have such a strong brand identity and a strong ecosystem. The average selling price of an iPhone in 2012 was a little over $600. There were over 800 by the year's conclusion. For the time being, it's likely even higher, and it doesn't even take into account the numerous subscription add-ons. There is no way out of Apple's clutches, whether it's AppleCare, iCloud, or Apple Music, and that's the point. Companies with deep moats that can raise prices without fear of consequences should be sought out during periods of high inflation. Second, you want the company to be able to handle significant dollar volume growth in businesses with only a little additional capital expenditures. As a result, if you can't pass on more costs to your customers, you'll have to absorb those costs yourself, which means decreased profit margins. For the same or greater profit with lower margins, you'll need to increase the amount of business you're conducting. Essentially, What Buffett is suggesting here is that you should look for companies that are both expanding and scalable. A shipbuilding company, for example, would have a hard time with this. Building a large ship is an expensive endeavor. You're not going to make a lot of money, but it's also difficult to raise the annual output of ships. A company like Facebook, on the other hand, could simply choose to increase the frequency of sponsored posts or other ads if they are unable to pass on the additional costs to their customers, who are the advertisers. This would require a massive investment in new shipyards and would take a long time to complete. As a result, when you're browsing on Instagram, you'll see 3 advertisements instead of 2. And it's a simple and fast process to accomplish. So, it's the second attribute that truly helps your company thrive, even during inflationary circumstances. To be able to grow their firm quickly enough that the reduced profit margins aren't a problem. If you're looking for the greatest plan during a time of inflation, Warren Buffett has one additional piece of advice. Buffett was asked about India's rather high levels of inflation at a conference because there's no getting around the fact that stock market trading in these times can be really difficult. People who were interested in investing were requested by the interviewer to give him some suggestions. According to Buffett, inflation is an invisible tax that only one man in a million truly understands, and that it's a tax on people who have faith in the currency that the government has issued. Therefore, the best protection and investment against inflation is to increase your own earning capacity. As long as you're aware of your own talents, you'll be able to utilize them, and if you do so, you won't be taxed from doing so. Your best defense and investment against a rapidly depreciating currency is to become more useful in your work and career. No matter what happens to the value of the currency, if you possess a stake in a successful company, your purchasing power will be secure. According to Warren Buffett, when inflation continues to rise, it becomes increasingly difficult to be a successful stock market investor. It's challenging, and your true return could be nothing. Therefore, it's probably preferable to invest in yourself and your talents so that you can earn more money and your personal purchasing power doesn't decrease. Maintaining your purchasing power when inflation has slowed down is easier if you know how much you are worth. You'll still be in a wonderful position to invest, and you'll probably be able to get your hands on some cheap stocks as well. As a whole, Warren Buffett suggests that we should invest during inflationary times in this manner. It all comes down to competitive advantage, and if your business has a moat and can raise prices without suffering any negative consequences, then those businesses can actually come out on top during inflationary periods. And the reason they come out on top is, unfortunately, because everybody else loses. I hope this helps you understand a little better how to handle this situation as an investor. As for now, that's all we have for you guys today. Once again, please click the bell icon to get notified when more videos on personal finance and investments go up. If you learned something from this video, go ahead and give us a thumbs up. Thank you for watching, and we'll see you again on the next video.